market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, it's red across the screen as the meltdown in gold and silver sparks a domino effect in stocks. The market reversal, which began on Friday, has deepened further, with gold falling as much as 10% and silver plummeting 60% at one point. Now, the dollar, meanwhile, has strengthened, extending gains made on Friday when President Trump nominated Kevin Warsh to lead the Federal Reserve. Now, we'll get more on the market reaction with MLive strategist Van Ram in just a moment. But first, to our Bloomberg breaking news editor, Alexander Pearson. Alex, what's been the political reaction to President Trump picking Warsh, and what obstacles might the nomination face?
Good morning. Well, the reaction in Washington, D.C. has been partisan. Republicans have, for the most part, welcomed the pick, citing Warsh's credentials and experience with the Fed. Democrats have voiced a lot more skepticism, saying they are concerned he might not operate independently of the White House or President Trump when it comes to setting monetary policy. That said, there is one important exception. Senator Thom Tillis, a Republican who sits on the Senate Banking Committee, has said he will oppose the nomination so long as there is an active investigation against current Federal Reserve Chairman Jay Powell. Tillis has long been a critic of President Trump and his pressure campaign against the Fed, and this linkage could certainly cause an obstacle to be in the way of the nomination going forward, and could threaten Warsh's ability to take over as Federal Reserve Chairman in May when Powell is set to step down.
Alex, thank you so much. Bloomberg breaking news editor Alexander Pearson. Now, for more on the market reaction, let's also bring Van Ram from Bloomberg's MLive team. So, Van, we've seen these big sell-offs in metals this morning. What's driven this?
Morning, Francine. I think that what has happened in silver and gold is classic behavior of what happens when prices are driven by herds. Back in the day when silver was trading around $28, $29, not long ago, just about a year ago, we had the fundamental story of a supply squeeze, and that was supporting silver through $50 an ounce. And thereafter, it became morphed from a fundamental trade to a momentum-driven trade, where it went from 50 to 75 in the space of no time at all. And from 75 onwards, it just became a speculative trade and a greed trade, and then it just exploded from $71 at the end of last year to $121 to a record. So there was so much money left on the table, and and then the investors came across an age-old problem. When there's too much money left on the table, there's always a tendency to to grab it first, and that's what happened, and that's what we have seen since in the past couple of days. Now, this all brings back memories of what happened in 78, 79. I wasn't watching the markets then, but what I can tell you is that at that point, it went from $4 an ounce to $32 an ounce in the space of just 1 year. And the drawdown thereafter was immense, 78%. What we have seen in the past couple of days is just about 30%. So there is much more to go if that episode plays out likewise.
Can you talk us through the slump in Bitcoin? What's that due to, Van?
Well, it kind of predates what's happening with silver, but I think, Bitcoin has fallen from a record to around, it's trying to find support around 75,000. There's no clear evidence that it is finding that support. But what is being tested here, Francine, is the idea that it is digital gold. It's the idea that it is a store of wealth, that it is an inflation hedge. All those theories are being put to the test, and there is no clear sign, as I was saying, that there is some support coming. So, and all these both these trades, silver and gold on the one hand and Bitcoin on the other hand, all suggest that this retail crowd, many of them, the Reddit crowd as I call them, they're piled into all these things as speculative trades, and now they are learning a very age-old lesson that you can't beat markets for too long.
Van, thanks so much. Van Ram there from Bloomberg MLive team. Now, for more on this, we're joined by Christian Mueller-Glissman, head of asset allocation research at Goldman Sachs. Christian, what a day to come on.
I know.
It feels like one day it's, everyone's happy and everything's fine, gold to the moon. And then is this profit taking, or is there anything fundamentally that's changed?
Well, I mean, I've just come back from Asia, where we had our macro conference, busiest ever, 4,000 people, and everybody was bullish. And I think there was a lot of consensus where investors were were obviously constructive on risk assets, but a few specific trades stood out. Bullish EM, bullish gold, bearish dollar. And at the margin, that creates the risk of setbacks, especially if there's extreme positioning. And what we've seen in the metals space in particular is a lot of speculative positioning building up in the last few weeks, which creates this short gamma dynamic. You can squeeze up very quickly on the way up, but also fall very much on the way down.
But Christian, what exactly is gold? Because I was led to believe that actually it's a lot of central bank buying, and this is a way of getting away of U.S. dollar assets or U.S. assets in general. I mean, if this is speculation from China or day traders, and it's a different kind of asset.
Exactly right. I think for most of the last year, I think gold was driven, the marginal investor was central banks. And central banks are slow, they're steady, and it's like a big tanker that essentially like moved gold, and that made it somewhat more interesting for investors, for asset allocators, because the big challenge of gold is, if you look since 1950, it's actually been a relatively low Sharpe ratio asset. Most of the time it doesn't do much, and then it has these very intense periods like the 70s, as was mentioned earlier, but also the global financial crisis, and now where it literally just develops this very interesting characteristic in the portfolio. And we've had that now, but the problem is, like in the last few weeks, exactly as you said, the speculative positioning from investors and all kinds of investors has probably picked up a bit too much, and that has meant that you've overshot versus fundamentals.
So what does it mean going forward? Or again, is it also symptomatic of Kevin Warsh becoming the new Fed chair because of his, I mean, is it because they're waiting for, is he hawkish, or actually does it change fundamentally how he views the economy?
I think you got to ask, why have people been so keen on gold? I mean, part of that is structural, which is linked to deglobalization, like both economically and politically. We've seen that really since Russia's invasion of Ukraine, that global kind of sovereign investors have diversified towards gold. And I think the other factor which has really accelerated the gold rally has been fears about the dollar. We've seen that obviously last year around Liberation Day, but in particular into the end of the year, into this year, like the market was worried about dollar weakness, about policy. And the fact is, Kevin Warsh at the margin seems to be quite a traditional candidate. He's been at the Fed before. He's got a track record. There's information about him, how his views have evolved. So maybe investors have relaxed a bit on the dollar view, which then means they can also be a bit less bullish on gold.
I mean, is this about geopolitics too? We've seen the market largely look through geopolitics.
Yeah, I think it's interesting. Obviously, this morning you also have a big sell-off in oil, and that to some extent would tell you that there's a bit of de-escalation on the geopolitical side, for example, related to the Middle East. I have not seen much news flow, I'll be honest with you, so it's not easy to square that. Maybe that's also reflecting the dollar being less of a concern. Commodities in general seem to be negatively correlated to the dollar because they're denominated in dollar. But I would say that the geopolitical risk into the midterms remains quite high. I think there's a lot of policy uncertainty with regards to the US, but globally, I feel. So at the margin, I would say that we're still very focused on building portfolios that are robust and can deal with these geopolitical shocks.
Christian, what do you do with AI right now? I mean, this is the next thing. I mean, we ask every day whether it's in a bubble or whether actually valuations and fundamentals make sense for it.
I would say that the market has traded AI relatively evidence-based. So especially in the US in the last year or so, it's been very much driven by earnings, less driven by valuations. Actually, outside of the US, we have to say, though, in Asia tech, valuations have been a big driver. So that explains maybe why also Asia tech has suffered a bit more in the last few days. But I would say that the market has been evidence-based. The problem is the AI capex evidence is starting to be a bit more mixed. Like, do we want more AI capex spend? Do we want less AI capex spend? The market hasn't made up its mind. Certainly the earnings season seems to behave like that. So it feels like AI capex cannot really drive the equity market as much anymore. And we've been saying that in our outlook as well. It's now about the applications and the adoption. And what our US treasurers have highlighted is companies are starting to mention the cost savings from AI. And if you get more and more of that news flow, that could potentially potentially drive another wave, but it's very different companies that are potentially winning. It might actually be the companies that are using AI that are rewarded for that.
Christian, does it change? We're also hearing that actually entry-level jobs are more difficult to come by because of how much a lot of these CEOs are spending on AI. Does it change labor dynamics?
I think our economists have been arguing that we'll have a great economy in the US this year, but the labor market will potentially remain somewhat weak. And I guess part of that is due to AI. Maybe the bargaining power of labor, especially entry-level, kind of junior-level people, is a bit lower, because you could argue that AI is able to do the most basic things, and when you are a junior person, you often start doing the basic things, and then you progress and build up your knowledge. And we know the big kind of like barrier to entry for AI is data, domain knowledge, and that you get with seniority, that you get with like experience. So unfortunately, you have this transition period where I guess entry-level jobs are more tough to come by, which means possibly there's a case to maybe go to higher education study. Maybe instead of going with a bachelor, you go to a master or even a PhD to keep competitive with AI. But I think we'll have to find out that equilibrium.
Christian, when you look at, I mean, you're still bullish on equities, but actually you have the hardest job in the business. When you look at asset allocation, what are the kind of forces that pull you in one direction or the other, given all the complexities that we've just talked about?
Yeah, I think you're right. We're overweight equity, but we're funding it out of credit. So it's a relative view where we just think that credit is the weakest link. There's like very tight credit spreads. There's a bit of a carry bubble, which is also linked to the dollar. If the dollar keeps strengthening, if the yen keeps strengthening, you lead to a lot of carry unwind risk. So we feel like carry as a theme across assets is something we would avoid. We do think in the type of backdrop we're in equities, like you can still deliver good returns driven by earnings with a bit of optionality on valuations. Late cycle, you get restructuring, releveraging, and structural growth that can still drive equity. And we have plenty of those stories, as we discussed. So we are overweight equity, underweight credit. But currently in our discussions, a lot about portfolio protection. What can we actually do to maintain that equity overweight? Because it could get quite a bit more bumpy into the midterms, but also with that bullish sentiment we have.
Bumpy across all asset classes?
Well, yeah, across all the risky assets. You could definitely see equities get a bit more volatile. You could definitely see credit spreads widen a bit more. I think our baseline is a bit like a spot up, vol up dynamic, where you often see that late cycle. You saw it in the late 90s, where equities kept going up, but they got more volatile. And last year was all about Goldilocks, very friendly volatility reset after Liberation Day, and you don't have that tailwind anymore, this kind of volatility reset. I think now the volatility might actually get a bit more elevated.
Christian, I mean, half the people that come on are very bullish on Europe. The others are not. So where do you stand on Europe? I mean, is there good value to be found, or is it just being left behind?
I mean, one good news is people don't seem to be bullish on Europe. I think like in these kind of surveys we do at the conferences and our conversations, Europe tends to be quite low in the list in terms of kind of bullishness. And that's good news, because you actually don't have this positioning dynamic which we discussed earlier. Right. The challenge is they're not bullish for a reason. There's relatively poor earnings growth. Our European strategists expect 5%. That's the lowest out of all of the regions. You have seen a decent amount of valuation expansion last year in the themes that people actually like: defense, infrastructure, and also banks. So at the margin, it's a bit more difficult. In the medium term, however, you could say that Europe could be a major beneficiary of AI, finding efficiencies and everything. So I think like we are currently underweight Europe in our asset allocation. We're overweight EM, a bit like the consensus. So we're a bit uncomfortable about literally the very short term, but sadly, the fundamentals for EM are still much better than for Europe right now.
Okay, Christian, as always, thank you so much for joining us. Christian Mueller-Glissman, Head of Asset Allocation Research at Goldman Sachs. Now, coming up, India's Prime Minister takes aim at President Trump with a budget that looks to support sectors hit by 50% U.S. tariffs. Details next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, India has unveiled a budget aimed at protecting its economy in the wake of the U.S. president's tariff threats. Now, the spending plan is packed with support for India's exporters who've been battered by U.S. tariffs, as well as fresh backing for strategic sectors like rare earths, semiconductors and critical minerals. Now, let's get more with Bloomberg's Dan Strumpf in New Delhi. Dan, thank you for joining us. So first of all, how badly is India's economy affected by 50% U.S. tariffs, and what has India done in response?
Yeah, so the tariffs took effect last August, and what's been interesting about the way that the effects have taken hold is that it's been sort of a slow impact so far. Economic growth in India is still quite robust, well over 7%, which is, really the envy of the world right now. And exports, including exports to the U.S., have so far not taken a seriously noticeable hit. Now, the concern in New Delhi, and this is being echoed across, a number of economists that we've spoken with, is that this year could finally be the year where the impact starts to really take hold. We do know that exporters last year, right around the time that those tariffs took effect, really front-loaded a lot of their exports to get ahead of the tariffs. The impact is starting to be felt more deeply now. So much of this budget is directed at providing support for some of those industries that are likely to be hit the hardest.
What kind of measures are offered in the budget, and what's been the market reaction?
So measures include things like support for some labor-intensive export industries. Now, in India, those include industries such as the leather sector, the textile sector, rug makers, marine products. The U.S. is a major buyer of Indian shrimp. This is an industry that's been badly affected, especially in the south of India. So there's more support for some of these industries. There's also support for industries that are exempt from U.S. tariffs, and that India has been pouring a lot more resources into recently. Now, that includes electronics components, that includes semiconductors, and other sort of high-tech sectors as well that India is trying to sort of prioritize. Now, to your question about the markets, the market actually so far did not like this budget. Now, that's not to say that the market didn't like the headline numbers and some of these supports that we're talking about right now. The real thing that investors seized upon were these higher tax rates on certain types of equity trades and derivatives trades, and these were mainly aimed at cooling some of the speculative fever that's kind of gripped a lot of the Indian market, particularly among retail investors, and that's contributed to a lot of the volatility that we've seen in the market in recent years. So that's the reason why there was a big sell-off. And then the second contributor was the relatively high amount of borrowing that we're expected to see to fund some of the initiatives in this budget, and that was really reflected in the bond market today, where you saw a big jump in bond yields in the Indian bond market.
Dan, thank you so much, our Bloomberg senior reporter, Dan Strumpf. Now, the British Prime Minister, Keir Starmer, concludes his East Asia visit, but some investors may question whether his trip did indeed make a difference to UK priorities. Now, my next guest argue it was pretty underwhelming, and China gained much more than the UK. Joining us now is Alicia Garcia-Herrero, Natixis Asia-Pacific Chief Economist. Alicia, thank you so much, as always, for joining us. Now, we'll talk about China in a second, but first of all, what's your take on India, and how can Europe, if at all, benefit maybe from the fact that India has also been slammed by U.S. policies?
Yes, very much so. That's exactly where we are, but the UK was there before also. And I think we have to see still that that benefit coming over. Why? Because as much as India is growing, actually highest growth in the whole of Asia, more than the Philippines in 2025, consumption is still quite weak. We do have imports from, luxury. So basically, we have a K growth type in India, where you have this basically employees of high-end services, digital services buying, and those are imports. But again, luxury final goods, but not so much intermediate goods, which is what India needs. Hopefully, the now very high tariffs on intermediate goods, machinery, etc., will come down so that Europeans can actually invest in India, manufacture in India, and re-export from India. Frankly speaking, and I heard the comments on the budget, subsidizing exports is not going to make it, because India's share of exports globally is only 1.8%. the economy
right.
as a percentage of global is 4. So it is not about Trump. It's really a problem in the Indian economy itself. So therefore, I think Europe and the UK before can help in that regard with manufacturing investment in India.
Alicia, if you look at Europe, I mean, is it easier to ratify, for example, Mercosur than the EU-India deal? And if yes, why?
It is for a very simple reason, actually, and that's the good news. And it's a bit technical, but let me clarify. Actually, the Indian deal only needs adoption by the European Parliament, not ratification. And the reason is that the Indian deal does not include an investor protection section, as Mercosur does. Let alone the fact that the India deal has actually put aside agriculture products. Quite a relevant issue to understand what's happening with Mercosur. So it is much easier to get to the final line, even if it started later.
Alicia, I mean, if we move further afield to China, what exactly are the dynamics in China that could help or hinder some of the economies here, including the UK? Yeah.
So what we would need China to do, if I were Starmer or any European leader or any leader for that matter, is for China to consume. We've been saying this for a long time. Not only that, China should import more to consume or invest. So in other words, 2 problems. China consumes little. Everybody knows that, but that's not all. China does not like to consume or use intermediate products that come from the rest of the world. That's the trend. Unless China changes that displeasure for foreign goods, in whether it's politically driven or not, or just it is very hard to tell. But that's the main problem. China needs to import more from the rest of the world, and if it doesn't, there's no way we can really make any gain out of this major economy.
I mean, is there anything that actually the UK could do in terms of R&D and investments? Could we model, I mean, could Europe, could the UK model itself on the kind of deal that Canada had with China? Yeah.
Well, what we heard is, of course, AstraZeneca's massive investment in China, out of which I think 2.5 billion, if I'm not mistaken, is R&D. Is that a good thing? Well, on the one hand, of course, China is a major innovation platform, and it makes sense to be in China. But at the same time, if you only innovate in China, if you transfer your R&D to China, to a large extent, a large part of your R&D, you also become a little bit captured by China, don't you? Because that's where your ecosystem happens. That is from where you will be exporting in the future. And that makes companies only more dependent on China. So I would say that I think it is good to rely on China to be in that ecosystem, but you need to make sure that you do not depend too much on China also for innovation.
So interesting. Alicia, thank you so much. Alicia Garcia-Herrero there, the Asia-Pacific Chief Economist at Natixis. Now, coming up, how much further can gold and silver fall? We'll delve into the metals meltdown. Next, we have really quite a lot going on. If you look at the markets, it's really the drop in gold that's driving everything. The drop in gold also leading to people questioning how much they need to change actually their diversification. Gold actually is extending losses after the biggest plunge in more than a decade. Silver's year-to-date gains also wiped out, with the metal slumping as much as 16% after an intraday loss on Friday that was the steepest on record. We'll have plenty more on the markets next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Metals meltdown, gold on track for its worst two-day drop since 1980, while silver's gains for the year are wiped out. Oracle announces plans to raise up to $50 billion to build more data center capacity as AI growth demands yet more investment. Plus, Iran's supreme leader warns of a regional war as the U.S. boosts its military presence in the Middle East. President Trump says he wants to make a deal. Now, pretty dramatic moves in the metal space is the dominant market theme. Right across the board means there's a lot of turbulence to analyze. Well, let's bring in Michael Haigh. He is head of FIC and Commodities Research at SocGen CIB. Michael, so good to speak to you. I mean, especially when it feels like it could be the end of the world, but it's not really. But you don't really know what function gold is now.
Well, I mean, let's think about what's been driving gold. It's pretty well established: central bank buying, ETF flows, managed money positioning. Yeah. We don't get to see the central bank buying real time, 3 months lag, 2 months if you look at customs data, 1 month if you look at London vault changes. My interpretation there is that they've paused. We know on Friday that hedge funds have reverse positions in both gold and silver, and ETF flows have been absolutely gigantic over the last several months. So that's what's been driving it.
Michael, what I've been underestimating is that there's a lot of Chinese day traders on these markets too, including gold. Yeah. Now, that was a little bit of a surprise to me. This is not central bank buying. This is like speculation. That's
right. And so last week there were reports of a bit of a clampdown on people opening up accounts there. Of course, these accounts have to post margin when it's a futures, and those have been rising with the volatility. The CME also has been rising its margin levels on a percentage basis rather than just a fixed value. So as the volatility has been picking up on the upside, these traders have had to cut their positions, both in China and in the US and here on the physical side.
So do we know how much that accounts for? Like if you look at central bank buying, because if central banks around the world look at US policies and say, actually, I want to get away from treasury, you know, longer term, I want to get away from dollar, then, you know, the gold is to the moon.
Yeah, that's right.
At some point.
Yeah, so I mean, China reports they have about 2,300 tons in their central bank. As I mentioned, it's kind of slowed down a lot recently. Poland has been picking up, of course. That hasn't really impacted the prices here in the short term, especially last week. It's the ETF flows that have really dominated. So to give you some perspective on China versus the rest of the world, if you think about global ETFs in gold, for instance, it's about 4,000 tons-ish. China was nothing a few years ago. It's between 200 and 300 tons. And that actually was the biggest increase in ETF flows since October was in China versus the rest of the world, particularly Europe and the Americas.
So what happens to gold next?
Well, I mean, we're going to stick with our forecast. I think the only thing that's happened is a removal of one piece of uncertainty about Fed independence, the nomination of Warsh. That's just one thing. When this uncertainty gets resolved, like we saw actually when President Trump was actually won the election, uncertainty was removed because we knew he was coming into power, and gold actually sold off because of that uncertainty coming off, but it came back up again. So I don't think anything's really changed fundamentally on the gold side, so I still believe it's going to go back up. It's going to be very volatile over the next week. Actually, this morning I was looking at options data bets to the upside and the downside on gold, and the biggest accumulation of calls upside for November of this year was at the $10,000 strike. So it's still up there, and there hasn't been a bit of a change actually today and Friday. On the downside, you know, the biggest accumulation is around $4,500 an ounce. So there's a big asymmetry there as to which way it could go. So I'm in favor of it. Once we get through this volatility, it's still going back up.
Michael, I mean, what about silver? So again, silver saw a spectacular rise since the beginning of the year. I mean, Friday was a rough day for silver, but is it a kind of, you know, the same reaction function than gold longer term?
It is, but you have to remember that silver is a market that is 10 times smaller than gold if you think about ETF values and hedge fund positioning. So it's going to do what gold does, but on a much more extreme basis. Historically, for every 100 tons going in and out of silver ETFs, you'd look at about a 5% change in the price of silver. Since October, that's 13%. So it's a much, much bigger impact on silver than gold. So when gold sort of stabilizes and starts to move back up again, silver will go with it.
I mean, I know you look at precious metals, but, you know, the best play could maybe be copper. I know it hasn't been as dramatic, but it kind of also has all the geopolitics there distilled in one metal.
Exactly. AI data centers, stock building.
Renewables,
everything. So there's a lot more supportive fundamental features behind copper. It got dragged down, of course, with silver and gold. I mean, obviously, copper and silver are co-produced. Out of the 25,000 tons of silver that comes out of the ground, about 6,000-ish comes out with copper. And if you look back historically to 1850, actually, they move up and down together. So it didn't surprise me it's come off. But for copper, you're right. I think there's a few more positive, strong fundamental features that should support that market.
I mean, is there anything so nothing's fundamentally changed, right? As you say, except for the fact that we now have a new Fed chair.
Yeah.
But nothing's fundamentally changed. What happens to some of these precious metals if there's like an AI bubble that bursts?
Well, I mean, this is the relationship between these markets and the equity markets, for instance, is not exactly clear.
Yeah.
And so what we're talking about,
well, meaning that sometimes it tracks it and sometimes it diverges.
Yeah, so it's a bit unclear as to what exactly it's going to react to there. It's a bit of it's a hard one to call.
So what are you looking for next?
So what I'm looking for now is central bank buying to pick up, because the prices have come down, so it probably makes that a little bit more attractive to them going forward. We saw that pause over the last couple of months, so I'm looking for that to pick up. When that happens, then that gives it that fundamental feature again that gives it that strong support.
And the data lags by what, a couple of weeks
no,
usually?
For
you
central
have
bank buying,
24 hours?
No. Central bank buying is 2-3 months. I mean, there's no...
2-3 months?
They have to report to the IMF. But, you know, so what we do with the central banks...
You must have secret data that you look at.
We proxy it with customs data and things going in and out. That's sort of a month or two lag. And, of course, a lot of the gold moves out of London, and we can proxy that by changes in the vaults in London, sort of with a 1 month lag. So, yeah, it's not perfect.
I could talk to you about this for days, but actually, what have we understood about how the Chinese are trading this in terms of the crackdown from China on speculative buying? Does it change like some of the meme stocks that they did a couple of years ago, or is it a different kind of policy?
It's a different policy. I mean, there's the Chinese futures market when it pertains to commodities is highly speculative. Okay. It's very, very different than the Western markets, which are much more producer-consumer oriented. So they've always been quite speculative. So I don't think that's going to change. Okay,
your best buy for the next couple of quarters?
I like copper. I agree with you there. I think that's a solid buy. Lots of fundamental reasons behind it. As you mentioned, the AI, the EV, the stockpiling, the military rearmament, things like that. So copper is my buy. Is there something that you're staying away from, or at least, you know, many questions? Well, I'm not staying away from oil. I'm shorting oil. I still believe that's quite bearish going forward. So I wouldn't go long oil. Okay, so interesting. Michael, thank you so much. So fun to have you on. Michael Haigh, Head of FIC and Commodities Research at SocGen CIB. Now, returning to the nomination of Kevin Warsh as the next Fed chair, the former Atlanta Fed president, Dennis Lockhart, says Warsh could face early tensions on the committee. Lockhart told us Warsh is seen as hawkish on inflation and the Fed's balance sheet, but his ultimate approach may remain data dependent.
You know, his history is that of being somewhat hawkish, both in terms of inflation vigilance and interest rates, as well as the balance sheet. And he continues to talk about reducing the balance sheet and reducing the footprint of the Fed in markets, which is, of course, would be interpreted as tightening. At the same time, he's been aligned with President Trump in the White House in recent remarks. So it's not clear to me which Kevin Warsh will show up in May. I think probably he will be data dependent, and with the committee will make the best decision he can. Given that there are 12 voting members on that committee, how significant is the influence of the Fed chair, and what do you expect to be sort of the direction going forward in the next 12 months? The Fed chair enjoys a great deal of deference from other members of the committee. And in my experience, when it's a close call, the chair's preference often prevails. Having said that, a new chair has to earn the respect of the committee. And so I think he's going to have a honeymoon period. And during that period, he'll be trying to conduct himself in such a way that reassures the committee that he's going to be independent. And we'll see how that plays out. I think Kevin Warsh will be navigating some tensions and some conflicting views on the committee. So it's not an easy road for him in the first few months. On the data front, there's talk that we could see inflation creeping back up. Certainly from the likes of PIMCO, that seems to be their assessment. Is there a chance that we don't even see a cut this year? Always a chance, particularly when you're looking forward early in the year. There's so many months ahead of us that it's very difficult to predict. My personal view is no cuts in the first half, but maybe a repeat in the second half of some cuts that look a little bit like the last 2 years. But that's just speculation at this point. It will depend on how the economy evolves. And we have both elements of the dual mandate, inflation and employment, showing a trend, but not a trend that could not be broken by new events. So it's very hard to predict, I think, at this stage. One more cut is a reasonable and plausible assumption, I think.
Well, that was the former Atlanta Fed President Dennis Lockhart speaking to our colleagues Sherry-Ann and Avril Hong. Now, in tech, Oracle announces plan to fund the expansion of its rapidly growing cloud infrastructure business and expects to raise between $45 to $50 billion of gross cash proceeds during the calendar year. Let's bring in Neil Campling, Bloomberg's senior strategist. So, Neil, this is a huge amount of money. How are they planning to do that?
Yeah, it's interesting that this time round they have announced on a Sunday evening plans to bring up to $50 billion through a combination of equity and debt. The point of being that they're bringing equity, which basically means they're coming to at the market, so there'll be price discovery immediately on this kind of structure. Whereas last year we saw the CDS spreads blow out massively, which was an issue for them. And we have to also remember that Oracle itself is unlike many big tech companies in that it has got a very leveraged balance sheet. So it needs to send that message to keep its investment grade.
But, Neil, so what are the main risks of the company? I mean, pre-market, look, the share price is down some 2-3%. I mean, are they risking big but just have to go through with this?
It is a question of you having to invest because we're still waiting to see the ROI for all this AI CapEx spend for all of the players in this marketplace. But as we've seen with tech waves in the past 20, 30, 40 years, there are very few massive winners from this. And if they want to have a seat potentially at the table, they've got to take this investment risk effectively.
Neil, talk to me a little bit about Jensen Huang of NVIDIA. I mean, he's always left, right, and center of anything we cover, but actually some of his recent comments are I guess, making investors concerned.
Yeah, I think though what he said at the weekend was, we are going to make a huge investment in OpenAI, but he did backtrack from the $100 billion investment that was talked about last September. So actually, investors will take some comfort that they're not just putting any capital at risk without due concern, and also making sure that the investment is going to be sort of responsible fiscally, which is essential for investors in the long term. Whereas NVIDIA also has to fund those AI investments that in turn obviously will invest significantly in their own chips.
Neil, thank you so much. Neil Campling there, Bloomberg's senior strategist on tech and AI. Now, the board of Walt Disney is said to be close to promoting the chairman of its theme park division to the role of chief executive. It's understood a vote on Josh D'Amaro will take place in the coming weeks. The 54-year-old has led the unit that delivers most of Disney's profits since 2020. If approved, D'Amaro will succeed Bob Iger, who ran the world's largest entertainment company from 2005 to 2020 and returned as chief executive in 2022. Now, coming up, Iran's supreme leader warns of regional war if the U.S. launches military strikes. We'll get some analysis next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, oil has dropped after notching its biggest monthly gain since 2022, after U.S. President Donald Trump said Washington is talking with Iran. It comes as the Iranian supreme leader warned of a regional war if the U.S. follows through with strikes on the Islamic Republic.
This gentleman regularly says he brought warships. The Iranian nation will deliver a firm blow to anyone who attacks or harasses it. The Americans know that if they start a war, this time it will be a regional war.
Well, let's bring in Patrick Sykes, Bloomberg's breaking news editor from the Middle East. Patrick, as things stand, how high are the military tensions between the U.S. and Iran today?
Yeah, on the ground, still high. I think the ticking element is obviously that US naval so-called armada, those naval assets coming into the region. We still don't know exactly where they are, but Trump said over the weekend a couple of days away from Iran. And then you have rhetoric from Iran at the top level from Khamenei there saying it would be a regional war if one were to happen. That being said, you mentioned oil there, and I think that's because diplomatically, rhetorically, we have seen a bit of a downtick in tensions. Earlier today, we had the spokesman of Iran's foreign ministry saying that messages were coming and going between Iran and the US via various intermediaries, various parallel channels of diplomacy going on at the same time. And he was saying that Iran hopes that they will bear some kind of fruit in the coming days. So there's indications of optimism there from Iran that there could be a diplomatic way forward. That's why you're seeing the dip in oil today.
And Patrick, OPEC Plus reacting with an ongoing freeze in production levels. So who's trying to keep things calm and get a peace deal between the US and Iran?
Yeah, interestingly, it's predominantly the regional countries, right? Middle East, the Gulf, but not only the Gulf Arab states who have been really active on the diplomatic front. Just in the past couple of days, since Friday, Iran's foreign minister has had calls or meetings with counterparts from Turkey, Egypt, Saudi, Qatar, the UAE as well. We saw the UAE president also cancelling a visit that had been scheduled for later this week to Japan. Another indication, I think, that for them, this is a potential crisis right on their back door. They've seen it blow back physically the last time around when Iran retaliated by striking US bases, and they're keen to avoid that again this time around.
Patrick, thank you so much. Patrick Sachs, Bloomberg's breaking news editor for the Middle East. Now, also with us this morning, Jasmine El-Gamal, founder and chief executive of geopolitical and communications advisor, Mindwork Strategies, and a former Pentagon advisor. Jasmine, thank you so much for joining us. I mean, first of all, what do we know about the situation on the ground in Iran? This was covered a little bit. There was a blackout. So do we have to start from there, or is it really the fact that we could be closer to a war without really knowing what the U.S. wants?
Right. I mean, it's a very, very tense moment in the region right now, and you can tell by the flurry of really high-level diplomacy that's happening from countries like Qatar, like Turkey, like Egypt, all trying to get the U.S. president to back down from his threat of a military strike. They've seen this play before. Obviously, the stakes are really high for them, and they're trying to convince Trump that there are still avenues for negotiation that haven't been fully explored. So we're going to see, hopefully this week, some of those avenues being explored.
Negotiations for what? To try and a change in leadership, or what exactly is the ultimate goal with everything that we're talking about?
So that's an excellent question, because really the question here is, are there actually topics to negotiate over, or are the two sides simply too far apart? So if you look at all the potential areas of negotiation, the potential areas of friction with Iran, you have their civil nuclear program, you have nuclear material that has potentially gone missing after the 12-day war, you have Iranian support for proxies in the region that affect the regional allies, you have Iran's treatment of the protesters that is now on the table as well, although probably less important to President Trump than all these other geopolitical issues. And then you have Iran's ballistic missile program as well. So the question here, and now we're hearing that the U.S. and Iran might be meeting in Turkey later this week. What is actually going to be on the table? Are all of these issues going to be on the table, or just the nuclear program, which many are saying is now not enough for the U.S. president?
But Jasmine, what do we know about these uprisings? So, I mean, thousands have been killed. Is that now over? Is there a balance in the country? Or it does feel like it's actually it's impossible to really see what's going on.
It's a very murky picture, but from what we do see coming out of the country, this has been some of the most horrific repressive action from this regime against protesters that we have seen in recent history. Speaking with friends in Iran, friends of friends, the stories that are coming out are absolutely horrific. Violence, indiscriminate violence, children, men, women, they are not differentiating. Really cruel practices like forcing families to pay a fee in order to retrieve the bodies of their family members. So even And the death toll varies widely, anywhere from 4,000 to 20,000, we've heard. But obviously, the bottom line is this is more serious than we've ever seen before. The question is, this is what President Trump is weighing right now. Is a military strike going to make things better, or going to take not just the U.S., not just the Iranian people, but the entire region down a really slippery slope that no one will be able to control? And we haven't even discussed the impact on global shipping prices, on energy markets. I mean, it's a really uncertain situation, and I think the more uncertainty you have, the more dangerous it is to look at military strikes as the #1 tool rather than negotiations to try to bring the temperature down a little bit.
But Jasmine, I'm going back to the uprisings. They're not, there was at some point talk about a change in regime because of the uprisings from within. Right. Is that now off the table?
I don't think anything is off the table yet, but I think the questions that people are asking around the president in the region, what does regime change mean exactly? Right. Because there sometimes tends to be simplistic ideas about what regime change means anywhere, not just Iran. Is it about the supreme leader leaving? This is an old, decrepit, really repressive man that is completely out of touch with his population, which is very young, vibrant, dynamic, brave, very connected. Is it about him leaving, but maintaining the rest of the structure, the IRGC, the security forces, in a different form, sort of like Venezuela? Or are you going to dismantle the entire system, in which case you have to ask other questions like, well, who's going to be in charge? Are the security forces going to listen to someone else? How organized is the opposition? You start going down to day after planning, which by all accounts has simply not been happening in Washington or elsewhere.
Jasmine, if you look at, I don't know whether you want to call it the task force that are helping with the negotiations. This is like Egypt, Turkey, Qatar, Saudi Arabia, the UAE. Or do they all want the same thing?
Pretty much. They want stability in the region. These are countries, I mean, if you look at what the region has been through, really since the Arab Spring, and it's been crisis after crisis after crisis. Last year, then you had the horrific war in Gaza. You have Syria just starting to get back on its feet, but obviously still facing huge challenges, economic security challenges. So the one thing that all of these countries can agree on, even though there are rivalries and tensions between them, is that this region does not need any more instability. That's the message from President Trump. The positive news that I see is that these negotiators, these intermediaries that you just mentioned, Qatar, Egypt, Turkey, are very trusted actors by the U.S. government. They helped get the Gaza deal. The president knows that they like him, or at least they pretend to like him. They have helped him get to what he wants, which was the peace deal in Gaza. He trusts them to make sure that he is kind of not straying too far away from what is best for everyone. So that's a huge deal, because usually when you have such intensely such intense distrust between the parties, there is zero trust between Iran and the United States. And remember that last time Iran and the United States were supposed to meet for negotiations, and the U.S. struck right before.
Jasmine, can we expect something this week? I know that, for example, the UAE president was meant to be in Japan and he canceled it. So in terms of timeline, how quickly could something happen?
I think with President Trump, again, as we've seen before, anything is on the table. And as I just said, the last time the U.S. and Iran were supposed to meet in Oman, Iran was struck by the U.S. and Israel. So I don't think anything is off the table, but from everything that we've seen, I think there is hope that negotiations will be ongoing before the president makes a decision on a strike.
Jasmine, thank you so much. Jasmine El-Gamal there, the chief executive of Mindwork Strategies and former Pentagon advisor. Now, there's a brand new show launching this week at Bloomberg Deals, which premieres on Wednesday at 5 p.m. London time. This is Danny Berger going through some of the biggest names in business, talking about deals and M&A. Up next, it's Bloomberg Brief, and this is Bloomberg.